Hi, I'm Morgan Smith. Welcome to WorthPointe Trending, a panel discussion on safety and opportunity investing in the COVID-19 era with our special guest, Apollo Lupesco, PhD, Vice President of Dimensional Fund Advisors. Disclaimer, investors cannot invest directly in indexes and they do not reflect fees or expenses of investments. Historical performance is not a guarantee of future results. WorthPointe is a fee-only registered investment advisor serving families and business owners across the United States with financial planning and wealth management. All of our advisors are designated as certified financial planning professionals and are also partners of the firm, so we are committed to taking the journey with our clients. Through conversations with our clients and partners, and given the current uncertainties associated with the COVID-19 crisis, we will continue to find ways to provide useful insights with thought leaders to help all of us better navigate the coming weeks, months, and years ahead. This is part one of this panel discussion, the macro issues, looking at the big picture. And our special guest today is Apollo D. Lupescu. He is responsible for communicating Dimensional Fund Advisors' academic foundations and investment beliefs. He presents an alternative to the traditional Wall Street approach. Apollo frequently speaks at various industry conferences across the country, as well as advisor client events. Prior to joining Dimensional, Apollo served in a variety of roles with the U.S. Department of State, from which he formed his own consulting firm, Apollo Consulting Group. His interests in finance and investments led him to teaching engagements at the University of California, Santa Barbara. Apollo received his PhD in economics and finance from UCSB and a BA from Michigan State University, where he competed in and coached water polo. The first area that we wanted to cover was kind of the macro big picture. So let's discuss some issues as they relate to the big picture. I think my first question is, it's really hard to sync up our emotions during periods of extreme uncertainty with the reality of investing our hard-earned savings in the markets. And, quite frankly, it can get kind of confusing and exhausting for a lot of folks out there. We read and hear news and often expect the markets to react in a certain way, but often the markets react differently than what we thought. So I wanted to explore, why is that? Is it because maybe we missed something? Do investors' own biases filter what they wanted them to hear, or is it something different?
Yeah, no, that's a great place to start, because I do feel that that's one of the questions that comes up most often, and you put it just right. Right now, at least where we stand today in early May, there seems to be a disconnect between what we hear on the news with 30 million people unemployed. We have the economy shut down, all these bad news. So when you open the papers and you read all these bad news about the economy, it just sounds really dark and bleak. And you turn to the investing section, and what you find is that the market has had a pretty remarkable bounce back after the lows from about a month and a half ago. So why is it that the economy is doing so badly, but somehow the market has staged this comeback? Is it because that maybe the worst is yet to come and we just haven't figured it out yet? And are we in for more pain when it comes to our earned savings? So let me start with that question, because I think it's very important. We're talking about things that are related. When you're talking about the economy and the market, they both have to do with businesses. And there's no doubt about it that there's a relation there, because it's all about business. How is business? And when you look at the economy, you see, well, the business not doing that well right now. And when you look at the market, you look at the same business and you're thinking, well, why is it doing so much better on this side of the market, but not on the economic side? And to really understand why is because when you look at the economy today, it is a snapshot of what is going on at the current time today, May 2020. What is going on today in the economy? That is the snapshot. That is one frame. What the stock market is something very different. It is not just how the businesses are doing today, but the stock market allows investors, people like you and I, to have a stake in capitalism in a way, because it allows us to buy ownership into these companies. So the stock market is tied to the ownership of these businesses. And the reason it's so different is because when I look at owning a business and I buy a share of any company out there that's traded on the market, what I'm really buying are payments that I expect to receive for years and years and years to go. So the difference, the fundamental difference is that the economy is about now and maybe what's happened in the past, whereas the stock market is about now and the future. It's a very forward-looking machine that is trying to figure out how much should you pay today to receive profits from these companies. That's the fundamental premise of the market. You're buying ownership in companies, and when you have an ownership into a company, you are entitled to part of the profits that the company will make, proportional to how much you own. So the stock market is not looking at what's going on right now. It's trying to figure out what will the profits of these companies be for years and years and years and years to go. So even though the situation might be bleak right now, what you're trying to see is what will those profits be 6 months, 1 year, 3 years, 5 years? And I have to tell you, Morgan, it is a very long-term proposition. You might not own a stock for 100 years, but the reality is that the price that you pay today reflects the fact that you expect to get paid for 100 years. And it's not unreasonable to say, well, how many companies have paid for 100 years? I'll give you some examples. So you have Exxon, you have Black and Decker, you have Eli Lilly, you have Con Edison. There are so many companies that have been paying investors for over 100 years. And that's basically what you're buying today in the stock market is future profits. And in that respect, if you look at the next 6 months, 9 months, a year, how much does it matter when you have payments coming for the next 50 or 100 years? So that's why there's such a disconnect, because the economy is about now, whereas the stock market, it's a very forward-looking pricing machine that's trying to figure out how much is this business worth in terms of all the payments that it will generate to shareholders.
It's so first off, that's a great explanation, because I think what happens is a lot of times people get focused on today and they forget about the future. And as you're talking about the future returns of these companies, really in my mind, working with clients and all of us here, we really think about projecting forward on the future income created by a portfolio, not just today, but 10, 20, 30 years from now. So that is interesting. So I guess to summarize your point, it's you really can't look at the economic data out there to determine why, what, when, how, and why the market's going to react the way it reacts.
Yeah, so let me try to kind of there are two analogies that might help your listeners. The first one is, think of the economy as being somebody walking a dog. And the market is being the dog, and it's a guide dog. And what I mean by that, they're both going in the same direction. But while the economy tends to go pretty steady, sometimes they go faster, sometimes slower. But it goes. The dog might be all over the place, and they're not the same thing. They're related. But I think, to me, my favorite way to kind of visualize this, to visualize the difference between the market and the economy, is think that what's going on right now in the market, it's basically a snapshot. It's a frame, and it's a single moment. But what really is important is that this frame, this scene, is part of a much larger movie. So what you need to do is play the entire movie. You can't get stuck at the first frame or one of the frames in the movie, because there are thousands of these scenes that will play out over the course of owning a stock. And that's the difference. Today is a snapshot. It's a frame. That's the economy. This owning a stock. It's a very long duration movie. And this it is actually a very long duration movie, because when I was telling you about 100 years, I wasn't kidding. All these are companies that have been actually paying shareholders for at least 100 years, and we recognize in all of these. And to really get a sense of that, the one that has been paying investors the longest in the U.S. Economy happens to be the York Water Company out of Pennsylvania. And it was about 40 years or so after when we went through the war with the British and we became independent. That's when they started to pay shareholders. And ever since, if you own a piece of this company, you would have gotten paid as a shareholder. That's what I'm talking about. It's a very, very long-term proposition. It is not based on what happens today. So you have to put some perspective. You have to play the movie all the way through.
Well, I got to tell you, I've never heard the walking the dog analogy, and I love that, having been a dog owner and getting yanked around by my dog, putting off saying that the stock market's kind of like the dog, and you're the economy. That's great. I love that. So I'll put that in my back pocket and use it someday if you don't mind.
Please.
Very good. Well, let's move on to the next question. The research by Eugene Fama and Kenneth French uncovered the value premium in 1992, and Rolf Bantz from the University of Chicago first published his findings on the small cap premium in 1981. So these are factors and premiums that we like to tilt towards. For clients and perhaps advisors alike, it might be frustrating for those who have invested with small and value tilts when those premiums don't reveal themselves for significant periods of time. What are your thoughts on this? Should we give up on the premiums, and how do we address this both as end investors and as people who are giving advice and saying, look, here's the research. It's peer reviewed and it's based on decades of good data. What are your thoughts on how to approach this conundrum, if you'd call it?
Yeah. No, it's and to begin with, it's so interesting because the research that started back in the 70s and 80s, over time, people have looked at it and in a way try to challenge it, either by looking at different time periods or looking at international markets. And over, what you saw is that the more people looked at it, the more the data actually backed it up. So the industry as a whole has moved in that direction. But what I like to start with actually is something a little bit different, which is asking the question why. Why should I expect this to begin with? So you mentioned these two what we call premiums, and they're sort of dimensions in the market. And what do we mean by that? Well, if you think of the stock market, and I'll just use the square to represent the entire stock market. All the stocks fit in this box. One of the challenges that investors have had, and academics for the very long time, was to be able to distinguish between different groups of stocks, because we all know intuitively that not all stocks are the same. There has to be a delineation, a way to separate and say, well, this group ought to behave differently than another group. And up until the late 70s, people looked at sectors and they were saying, well, pharmaceutical, transportation, technology. And when they looked at it, there's some problems there. The first one is that there was no good economic theory why one sector should deliver higher or lower returns to an investor. The second one is that it's not easy to categorize a company into a particular sector. And today, if you look at Facebook or Google, they're considered to be technology companies. And yet, when you think about it, what they're selling is advertising and media. They're competing with Disney and Viacom. So to me, the big breakthrough came in the 1970s and late 70s when an academic actually looked at economic theory as well as data. And you mentioned his name, Rolf Bantz, and he was at Chicago at the time. So what he did, he basically suggested this, that when you look at the U.S. market, there has to be a distinction between large companies in the market, and these are the well-established, mature, grown-up companies, the blue chips, the Jumbotron, well-known, Apple, McDonald's, Google, Coke, Johnson & Johnson, all these big companies, Chase Bank. And that's what you typically see in the S&P 500, which is a broad measure, not of any one of these large companies, but the 500 largest companies in the US. There are about 2,000 other companies in the US market: New York Times, Bank of Hawaii, GNC Nutrition, Columbia Sportswear, you name it, Buffalo Chicken Wings. And all these companies are not part of the S&P, but they do trade on US markets, and they're called small caps or small company stocks. And intuitively, what Rolf Bantz had kind of defined back then was that if you look at the at investing money, there has to be a relationship between the uncertainty of a company and what you get paid as an investor because you are deploying capital. So if you have a McDonald's and you have, let's say, Shake Shack, which is another burger joint that trades on the market, um, McDonald's is a much more mature, well-established company, whereas Shake Shack is still a large company relative to other burger restaurants, but they're not nearly as much as big as McDonald's. So if you think about it, if I have a choice and my money grows at the same rate between McDonald's and Shake Shack, it seems I would have more mature. The more mature company would give me more certainty because they have a track record. They've been through things. So if there's the payout is the same between small and large, I'm just going to go with this with a large. Why bother with the small ones? So the small ones do have to give investors a bit of a kicker. They also have more room to grow. I can see Shake Shack maybe doubling a little bit easier than McDonald's. So
Right.
to see this at play, probably the best thing is to look at the Matrix book. And I know we're virtual. I wish. I mean, I know you have a book there like that, and it shows you probably in the easiest to understand terms how to think about the difference between large and small. And it has to do with how much would the dollar grow. I'll take my dad's lifetime. My dad was born in 1926. And the question is, what would a dollar have grown in his lifetime to the time he was 92? He's 93 today, in these two different types of investments. In large company, $1 invested in the S&P would have grown to about $7,000. A really nice growth in my dad's lifetime invested in the S&P 500, which is a measure of the large companies. If you had taken the same dollar over the same time period and invested it in the small companies, then in the Matrix book, you see the answer. It would have grown to roughly 27,000. So much bigger growth between large and small. And then, that's kind of one of the ideas that I do expect that to some degree, because if that doesn't happen, why would anybody invest in the smaller companies? And then in the 80s, as you mentioned, there was this notion about all the large and all the small. And what came about is that the idea that when you look at owning a company, it's not just the fact that you own it, but how much do you pay to own it relative to a company fundamental. And the companies that have the stocks that have a low price for their fundamentals, whether it's earnings or book value, there are different metrics you can use. Those are called value stocks. And over time, they've outperformed the more expensive counterparts called growth. And if you know that small outperforms large historically, and then value beats growth, the one asset class, the one part of the market that ought to give you investors the biggest bang for the buck is one that has small and value. And once again, from the Matrix book, that number is about $72,000. So to me, that's the way that I think that this asset class investing has progressed. Look at the market and then be very very purposeful. And the more you want to emphasize small companies and value stocks, the more you give you a chance to earn higher expected returns. That's what it is. And what's the catch here? Because this well looks really good, but what's the catch? The catch is exactly what you mentioned earlier, Morgan. The catch is that when you look at this and you're saying, well, small outperforms, value outperforms, you might say, well, that's kind of what I expect to see. Well, it's not there every single day. These companies, smaller companies and value stocks, for sure, they carry more uncertainty. That's the reason you get paid more as an investor. And when you look at this, what you have to consider is not that small beats outperforms or value outperforms, but you want to consider the odds. That's what really matters in investing. I think really smart investors are not looking at investing as guarantees and certainty, because that's not what investing is about. I think investing in life in general is about managing odds, statistics, and probabilities. In fact, I used to not be very healthy in the way maybe I smoked at some point and I wasn't very healthy, didn't work out much. And I switched. Now I'm a lot healthier. I don't smoke. I work out every once in a while. I pay attention to what I eat. But that doesn't guarantee me or anybody else a longer lasting, healthier life. All it does is just improves the odds. So that's why I think it's really important to look at the odds. So when you look at the odds, what you see is that over 1 year, these are very rough numbers, very rough numbers. Over 1 year, you look, for example, at small companies outperforming. What you see is that roughly about 57% of the time in any 1 year, you see that indeed, yes, small would outperform. And about 43% of the time, It won't. And 57%, you still have better odds in any one year that small will outperform, but it's not a slam dunk. The question is, if you saw these odds, which part of the market would you like to emphasize? And if you give it more time, and if you go from 1 year to 5 years, for example, that improves. Now you have about two-thirds of the time that you see indeed small outperform. But even now, you have a third of the time that it's not there over 5 years. So that's why it becomes a matter of odds. That's why it's really important to understand that when you look at the odds, your odds are better with that small outperforms, and it will happen two-thirds of the time. But you have the one-third that's not going to be there. So you have to be careful to manage your expectations, because these are 5 years that you don't see that. It's just not common. I mean, it's more common to see, obviously, small, but it's not unprecedented. It happens about 1 in 3 periods, and that's what I think it's really important for investors to understand. You are buying into an investment philosophy, into a system that is much more data driven, is much more evidence driven, and that you are part of the what this requires in order to work is discipline and managing expectations.
So so that's great. And as an investor, you don't think that I should lose confidence if I happen to be recently in that maybe one third block for the last 5 years. There's no data to suggest that these premiums have magically gone away, and it's just a matter of time.
It's no, absolutely. Because I
Okay.
mean, I would go beyond the data and look at the economic intuition. Has something changed with respect to the reason why I expect small companies to outperform? What is making me believe today that economically these large, well-established companies would have to pay a higher interest rate in a way because that's what you're doing. And when you put in the money in the market, you're basically getting a return. Why would I expect that the large, well-established companies would pay me more? It's almost like I'm 50 years old. If I walked into a bank today and I get a loan, if the same exact me walked in the same bank 25 years ago, why would I expect that the Apollo 25 years ago would pay a lower interest rate than the mature grown up Apollo? Well, obviously the track record does matter. So the cost of capital for these companies has to be lower. So even economically, absolutely, I believe that still continue to be the case, not just in the data.
Very good. So in essence, you're emphasizing something that we talk about is that uncertainty creates a potential for more risk, and there's a risk reward. There's a connection between a risk reward that never goes away. So that's, for example, one of the rationales behind a small company premium. One kind of tangent to this is maybe these premiums were a little less well known decades ago. Do you think the fact that maybe more money managers are taking advantage of these premiums, that is there any evidence that they will be diminished
Right.
moving forward?
Right. Well, it's everybody has known about this for a long time, and in my opinion, that the knowledge of a premium itself is not necessarily diminishing it, because everything is relative to something else. And I'll give you, just to start with just a quick analogy. Everybody has known there is what's called an equity premium, meaning that the stock market ought to pay investors a little bit more, quite a bit more than the bond market, because the bond market, you have an interest rate that you receive. There's a lot more certainty onto that because there's a contract in place. So if you think about the equity premium, which is the difference between what the stock market paid versus what you get in bonds, everybody has known about this for a very, very long time. Do you see that this what's called equity premium is now lower just because people know about it? Uh, in my opinion, we don't see that in the data, and intuitively, you don't expect that to happen. So even if the premium is known, it still will reflect the relative riskiness of companies. So it's all about the relativity of it. That one has to be relative to the other. It's the same with these with these FICO scores. And I just recently was teaching a class to middle schoolers about just understanding a little bit of the basics of finance. and money. And one of the things that I show them is if you look on the FICO score website, it shows you what would be an interest rate on an auto loan depending on your FICO score, which is your credit score. And what you see is that it's a relativity. Everybody knows that the consumers that have a lower FICO score, you're going to get paid more as an if you're willing to lend them the money. And it's so that's been known for a while, and you don't see everybody converging in that area. There's still a range because people, investors, do have preferences around deploying their capital.
Yeah, that's so it's cost of capital. That's something we talk to our clients about a lot when they go out there
Absolutely.
in the marketplace as consumers. Well, good. In summary, for our listeners, that was the kind of macro big picture section of our discussion here. The first summary really is kind of it's really hard uh, to marry what's happening and how the market moves relative to the economic news that apparently exists out there. So it's hard to make decisions on that. And I guess the second thing in summary was look at these premiums that many advisors look to and tilt towards in client portfolios. There's no evidence that they've magically gone away, and even though there may be some underperformance in recent periods.